This video is a tax update regarding financial statements. I'm your professor, Dr. Stephen Haggard. Once upon a time, about 1986, in this country we had two political parties, and we still have them around. The difference is that they actually got along and worked together like responsible adults to craft legislation for the benefit of the country. And so what happened back in 1986 is a president named Ronald Reagan and a Speaker of the House named Tip O'Neill, who came from two different parties, sat down and worked together to put together a tax package that would stimulate the economy. And that's always the purpose of these tax packages when they're rolled out, is that they're intended to stimulate the economy and get people into jobs. And so that's what they were trying to accomplish back in 1986, and it's what they were trying to accomplish in 2017 with the new tax law. So we had the same tax law for 31 years, which is actually kind of impressive. Okay, so let's talk about what's happened here with respect to financial statements. Our Tax Cuts and Jobs Act of 2017, which is actually a fairly plain name for these kinds of things. Usually they try to make it sound like some sort of acronym. But it did several things. And the first one is it changed C corporation tax rate to a flat 21% from a progressive system. Now, first of all, let's point out C corporations, there are also S corporations, there are many other kinds of legal entities that businesses can register under. So this is one particular organization, the C corporation, that's got a flat 21% tax rate instead of a progressive system. Now, what's a progressive system? That's a system in which you have brackets and it's the way our personal taxes are in the United States. When the first however many $1,000s you make might not be taxed at all. And then the so many thousand over that might be taxed at 10%, and then some more, a higher bracket above that taxed at 15%, and so on. Now, you never pay the higher tax on income that falls in the previous bracket, so it's just new income in the new bracket that gets the new tax rate. But what this means is the more money you make, the higher the percentage of your income then goes to your taxes. Now, the law changed just for C corporations. All the other entities remain in a progressive tax system. So you might have been asking yourself, why in the world did we need to learn about progressive taxes if corporations are no longer taxed that way? And the answer is that everything except for the C corporations are taxed in the progressive system, including your personal income tax. So it's good to know how this stuff works anyway. Now, previously, when we talk about progressive systems, usually the marginal tax rate is higher than the average tax rate. Remember that the marginal tax rate is the tax rate that you pay on the very next dollar of income earned. And since that's going to be in the top bracket for whatever you're doing, it's going to be the highest rate of any dollar that you pay. It's going to typically be higher than the average tax rate. Well, what's the average tax rate? That's just our total tax divided by the amount of taxable income we have. The interesting thing about a flat tax is everywhere and always the average tax rate is equal to the marginal tax rate. Now, keep in mind, when we're talking about making decisions about investments, we are always concerned about the marginal tax rate because we're interested in the incremental taxes as a result of making the investment, not the average tax rate, which would include the lower tax brackets. Another change that this Tax Cuts and Jobs Act of 2017 made is this bonus depreciation that allows firms to completely depreciate non-real estate assets in year one. But that's a limited time offer, and in another video I will talk some more detail about how that works. But this is actually good for companies, even though it makes their net income lower in the first year. It reduces their taxes. Keep in mind that depreciation isn't a real cash flow, no matter what accountants might think. And as a result, we really would like to have the greatest amount of depreciation possible because it lowers our taxable income, which lowers our taxes, and taxes are a real cash flow. And then finally, we have limitations on interest deductions. It used to be that every bit of interest that you as a corporation paid could be subtracted before figuring your pre-tax income. But that's not the case anymore. There are some limitations on that. And of course, since the government's involved and our leaders are primarily lawyers, it's kind of complicated, but the general idea is this: not all of your interest will be deductible anymore, but your non-deductible interest can be carried forward to future tax years. Now that only helps if you're planning, say in the future, to sell some assets and pay down some debt so you'll have less than the maximum amount of deductible interest. But if you're just planning to maintain your same operations, your same capital structure, your interest is likely not to decline enough that you'll be able to take advantage of this. It's kind of like having an operating loss that you could carry forward, but if you never make a profit, you'll never be able to utilize it.